Okay, this is Chapter 10, Flexible Budgets and Standard Cost. So what we're going to focus on here is the budget for a single unit and the quantity and the price. So we want to try to figure out how much it should cost to make something. So how, in terms of your inputs, what is the quantity you would need and what is the price you expect to pay. So those are your standard costs. The next category is, if you're making your products, is you need to know about the quantity of direct materials, direct labor, and your manufacturing overhead. So when we talk about standard cost, here when we look at direct materials, we are calculating for this product Gunite. So for the Gunite, we need 24 meters per pool, so we're looking at swimming pools. Plus, there's always waste and spoilage when you're making something, so they're allowing 1 meter for wastage. So the standard quantity of Gunite that you would expect to use is 25 meters. Then when you're looking at your standard pricing, you are calculating that as the purchase price of the materials, which is here $76 per meter, plus your freight in, so the cost to transport that product from its facility to your business. So the standard cost is $80 per meter. The standard cost for direct labor, we are anticipating that 400 hours would be needed per pool, and we're committed to an hourly rate of $8 per direct labor hour, plus payroll, taxes, and fringe benefits of $250. So the rate is $10.50 per direct labor hours. Obviously, wages were a bit lower in this calculation than today's going wages. The standard rate now for overhead, so you would calculate this as being your variable overhead plus your fixed. So here you look at your total estimated variable overhead divided by the total quantity of your allocation base. So when you're looking at the cost of inputs, we look at your direct materials, which we've just calculated, your direct labor, plus your overhead. Then you have your fixed cost as well. So when a company is doing its budget, so it sets the budget before the beginning of the year, and of course this is just an estimate. You know, things will always change a bit from what you had anticipated. So in this first column, this is your actual cost, so what you paid, your the actual cost times the number of units. But column 2, what we call flexible budgets, this is what you would have expected to pay to do the 10 pools. So you would have expected to pay $20,000 in materials, $42,000 in labor, $8,000 in variable overhead, and so on. So the third column is calculating the difference between actual and flexible budget. So what did you actually pay versus what you should have paid? And if you paid more, then that's an unfavorable variance, or if you paid less, it's favorable. So that's what the third column is doing. So you go down through each of your actual expense categories and compare the actual costs incurred to what you would have expected to pay based on standard quantities and standard cost. So when you're looking at the variance, you can have a variance for two reasons. One is price variance, so you can end up paying more per unit. So maybe there was a new collective agreement that took place during the year, and maybe the wage rate went up. So that could be why your wages went up, or maybe, the price of gas went up, so delivery charges are higher. There's any one of a number of reasons why the price and quantity could vary. So you have your total cost variance can be broken down into how much was due to the price per unit being different than what you had thought, and how much is being reflecting efficiency variance. In other words, did you use more units than you should have? So how much is due to price and how much is due to efficiency? So when you calculate your price variance, the easiest way to do this is the second option here, where it shows actual price less standard price times your actual quantity. So that's your price variance. And then efficiency variance, what was your actual quantity that you used? Subtract from that the standard quantity, what you would have expected to use, times your standard price. So those are two formulas you will definitely need to remember in order to do this type of variance analysis. So we just talked about earlier about the flexible budget variance in terms of being explained by price, how much you paid per unit, or efficiency, how many units did you use. The next category is sales volume variance. So the actual number of pools manufactured was 10 pools, but when they did their budget at the beginning of the year, they were anticipating only making 8 pools. So that's your sales volume variance. So different managers throughout the organization are responsible for explaining the variances. So the purchasing manager would be responsible for explaining why the price of materials increased. So that purchasing manager would be looking at price variance. Whereas if you had an efficiency variance, if you use, say, more units than you would have expected to use, your production manager is expected to provide that explanation. So maybe there were some defective units, so you ended up having to scrap them and use more material to make more units. It could be any one of a number of reasons, but the production manager has to explain that. So when you're looking at overhead variances, both you could end up with variances in both variable and fixed overhead. So we just talked about spending variance, like something cost more per unit than you had planned or less. In efficiency, you used more units or less units than planned. Whereas fixed overhead, it's a budget variance. You're looking at, for example, what you had expected to pay for your insurance, and you may have had it on your manufacturing facility, and maybe there was a policy adjustment partway through the year, you ended up paying more. And also, fixed overhead could be impacted by the volume variance as well. So the overall takeaway here is you have your static budget, which is prepared for one level of sales volume. Then your flexible budgets, that's prepared for different volumes. So you might have started off with a static budget for like 8 pools, but then you would also want to do what we referred to in previous chapters, sensitivity analysis. So you would prepare a budget based on maybe selling only 6 pools or maybe selling 10 pools. So you have some range of possible outcomes as to what your cost might be. And of course the variance is the difference between the actual results and the budgeted cost. So here we're still looking at the pools. So actual results, we know we ended up selling 10 pools we had planned our budget based on 8, so your variance here is 2 units, so, but it's a favorable variance because you sold more than you had planned, which is good. And then, of course, your sales revenue would obviously improve because you sold more units. And of course, if you're selling more, your expenses are going to go up as well because you've got to, make the extra 2 pools. So overall, because your sales were higher than you had predicted when you set your budget, the operating income ends up being $4,000 favorable.
Yeah.
So the whole point of flexible budgets is to help management figure out why the costs are different from what they had anticipated when they set their budget. So why did the unfavorable variance occur? Did you waste some materials? Did the cost of materials increase? Maybe there was some business decision that changed the expenses, such as deciding to give the workers a raise, for example. So when you're doing your flexible budget, so here you see that the company has calculated what its income would be if it sold only 5 pools, 8 pools, or 11 pools. So once you know your cost per unit, you can easily then do various calculations. So when they sold only 5 pools, if they're only going to sell 5, you don't make any money. You just make enough to cover your expenses. If they sell 8 pools, they would make $12,000. So 11 pools, they'd make $24,000. And that's often due to the fact that your fixed expenses, for the most part, remain fixed. So even if they only sell 5 pools, their fixed expenses are still $20,000. Or if they sold 11 pools, the fixed expenses is still $20,000. So the flexible budgets are used to help management plan for the future and help them control costs. So if they're looking at their budget, their actual results compared to their budget, they may need to go in and change their future predictions because, maybe the cost of materials have increased and it's going to continue on for, the subsequent 1 or 2 years. So you'd have to go in and change your budget accordingly. So here you're looking at your static budget variances. So static budget is based on the expected number of outputs, whereas flexible is based on actual. So you have your flexible budget variance and your sales volume variance. So to calculate your sales volume variance, you take your static budget minus your flexible, and that would give you the difference. And flexible budget, you look at the number of units actually sold minus the actual number of units. So here we see an income statement where you're looking at your actual results and you're comparing that to your flexible budget. So the last column over on the right is your static budget. So when you prepared your budget, you were anticipating selling 8 pools, but you actually sold 10, which is the first column. That's your actual results. So the third column, the flexible budget, is identifying if I had set my budget for 10 units being sold, what would I have budgeted? So what would I have expected in revenue and what would I have expected in expenses for selling 10 units versus the 8 that they had predicted? And that concludes the PowerPoints for this chapter.